WIX stock, which was once viewed as a huge beneficiary of the global lockdown and a darling SARS stock, is now down 47% from its 2021 high, or year to date 2021, and now trading at pre-COVID prices. As referenced on a price to sales basis, this is the cheapest the business has been for 3 to 5 years, bar a 2-week period in March 2020 when the stock market crashed. And I've been buying WIX stock recently as it reached my buy range of around $160 per share and have continued to buy it on its way down to $135 at the moment. And in this video, I'm going to be explaining why I think WIX is a compelling investment opportunity at this price. Firstly, for context, let's look at what WIX offers to its customers and also take a look at the industry dynamics. So obviously WIX is a website builder. It allows individuals, businesses with no coding experience necessary to use templates tailored around many verticals and launch their online website. And it also has newly launched products such as Editor X and Corvid, or now known as Velo by WIX, that are targeting the professional designers market too, which actually represents, believe it or not, a bigger TAM opportunity than the fast-growing legacy business, which is individuals and businesses. At the moment, that is. And although WIX actually allows users to build their website without even paying a penny, otherwise known as a freemium model, to create its own domain and use it in full function, WIX adopts a subscription or SaaS revenue model where users pay monthly or yearly or on a multi-year basis to use the platform. Interestingly, around 80% of the subscription users opt to pay on a yearly basis rather than monthly, which hints towards the stickiness of WIX's product. And proof is in the pudding with over 110% or 113% to be exact annual revenue retention rates for their premium subscription business. And when you think about it logically, paying anywhere from $15 to $50 a month to run your online business is a minute cost and one you don't tend to cancel unless something goes seriously wrong. But beyond just building a website for yourself or your business, WIX has over time created a business solutions offering that allows users of WIX to truly run their business online. And this offering includes things like WIX payments, marketing and communication tools, and Ascend. And although this segment isn't as attractive as the core business, the subscription business in terms of its unit economics and gross margins, it is allowing WIX to come away from the traditional website building space and become a facilitator of e-commerce whilst collecting the rents for the domain, similar to the likes of Shopify. And although I will admit Shopify's e-commerce offering is probably better at the moment, it does give WIX the ability to go out and compete for customers with the likes of Shopify and others. Business services revenues are growing fast, above around 60%, but they do come with lower gross margins because of the nature of payments. The gross margin sits around 30% for the business services business versus the core business's gross margin of around 80%. And where it now makes up over 20% of total revenues, it is having a bit of a drag on the overall gross margin that the business is reporting, at least for now. And that is something that I feel investors are looking at. They're looking at it thinking maybe WIX isn't as competitive and it's getting competed out of business, lacks pricing power. That really isn't the case. The reason for this drag in gross margin is because the business solutions revenue is growing so quickly, and that only carries a 30% gross margin at the moment, but is growing as you would expect as payments start to scale up and they utilize the infrastructure they've already spent on. So that's a bit about the business and how it makes money. Now I want to look at the industry dynamics, as this is one of the controversial matters of WIX, and the main reason, I guess, why I wasn't willing to pick up WIX stock when it was selling at, say, $180 per share to $200 per share, even though it was seemingly below the generalized 8 to 10 times sales that the market traditionally gives SaaS businesses. And that's because it is a competitive industry and there is viable alternatives to WIX. If people don't necessarily like what WIX is offering, they can use WordPress, they can use Squarespace, they can use smaller providers as well. And I'm not going to go into deep detail about why I think WIX is the best overall option, not necessarily towards professionals, but more for individuals or lesser experienced designers. But I do think that it is overall the best offering. And it seems like the consensus agrees with me for now. And that is evident not just in some articles that industry experts or publications have put out, but it's also evident in WIX's numbers. But the point here is that even if WIX is better at the moment because of one or two new products, or they have pricing or size advantage for now, there probably isn't enough of a gap to call this a clear market leader, even if it is one at all. But I think the potential market size, which is huge by the way, and the many verticals that they are adding, that gives us more than enough room for WIX and the 3 to 4 other competitors to exist and even thrive in the industry. But more importantly, I think at this price, we are compensated for some competitive forces and even potential commoditization of the industry or the business. And I'll go into this part in some detail because it is really important as to the investment case for WIX and trying to balance off some of the negatives. But the first reason we need to understand is how powerful sticky recurring revenues like the ones that WIX earn actually are. Using their client lifetime value calculations and net retention rates, they can actually forecast quite accurately the existing customers, what sort of revenue they will generate over the next 10 years. And they estimate that they will generate close to 15 billion of revenue over the next decade versus just a market cap of 7.5 billion. That's around an average of 1.5 billion of revenue or collections annually on what we'll see in a moment, really good unit economics. Now, keep in mind, these are calculations or estimates from WIX. Some of them will be quite accurate because of the annual contracts they have, the recurring revenue streams, and the past data on retention, but it is estimates. It's not booked revenue, it's not guaranteed or contractual that they're going to receive the whole 15 billion in the next decade. And so the second part as to why the price of WIX stock today is so compelling to me and provides us with some margin of safety is the hidden underlying unit economics that actually show, even though on a reported basis WIX isn't profitable at the moment, WIX could be extremely profitable once running at a steady or mature state and stops prioritizing the acquiring of new customers. And so you get an idea for what I'm talking about if you look at this. So we look at WIX's return on acquiring a customer. So as WIX has little to no tangible assets or capital required to actually run or grow the business, apart from some spending on internet or cloud infrastructure, probably paying AWS, its main direct cost is marketing. And so demonstrated here, the total return on investment is really high. After about a year or 4 to 5 quarters, WIX earns all of its money spent on acquiring a new customer back through revenue or collections. And this is very high even for a software business such as WIX. I think the likes of maybe GoDaddy has around 2 years and some other comparable companies as well. It's usually around 2 years. So they're taking the payback time, they're cutting the payback time, in half, which is very impressive. And depending on what we believe to be their underlying earnings or margin on the revenue, we can calculate a rough return on reinvested capital or incremental capital as a real key indicator of business quality. But we'll look at that a little bit later. Now, the next thing I want to look at is the income statement and financials for WIX. As like I've said before, WIX has great existing unit economics for its existing customers and could be profitable at any point if it chooses to. It would probably cost them in terms of growth and new users, and the market wouldn't react that well to that in the short term. And I wouldn't expect them to do it anyway. But it's a way of deconstructing the business and the income statement and trying to understand and find the true value within a SaaS business like WIX or some of these businesses that are traditionally hard to value and you can't use the traditional valuation metrics on them. And so you can see here I have my DCF analysis for WIX, and within it, it's past results, which is what we're going to focus on first. And the first thing is, look, this business has been profitable on a free cash flow basis for some time now. Okay, amortization of intangibles and also stock-based compensation at around 10-15% of revenues has dragged the net income down, but they are non-cash expenses. So if we look at the cash the business generates, it's been profitable for some time. Stock-based compensation actually is tracking back down now. They managed to actually buy back stock in 2021. So the shares outstanding in 2021 have reduced from a couple quarters ago. So I think stock-based compensation definitely is on its way down, and it's not something, although we should be worried about stock-based compensation as a shareholder of the business because it dilutes us, I don't think it's something we have to be concerned about going forward too much. And so the main focus here is How profitable could WIX be if it slowed down on its growth spending? Not even stopped it, but just slowed. And the calculations I've done here, we're just going to drop down here. I think that they could get quite easily to a 25% free cash flow margin. Previous years, it sat around 15, 16%. This year, 2021, down at 3 to 4%, probably because of all the investments they've done, which we'll look at in a moment. But if we just estimate that out of this R&D, sales and marketing, that 30% of that is growth spending, all right, incremental growth spending that isn't a necessity to maintain the business. And actually, on a steady state basis, as the business matures, they wouldn't need to even spend that much as a percentage of revenue. So we're going to strip that out. I actually think in reality, around 50 to 60% of this R&D and sales and marketing is growth spending, because R&D and sales and marketing traditionally are growth spending. They're spending this money to acquire new customers, and they're spending that to develop new products. So it is growth spending. G&A is only a tiny percent of their revenue at 148 million versus 1.2 billion in annual revenue. So what we're doing, just to recap that again, 30% of this cost, of this operating CapEx, is incremental growth spending that we will strip out to give us a hypothetical underlying free cash flow margin. And you can see here that the underlying free cash flow margin using that is around 25%. And if we take that underlying free cash flow margin, or hypothetical free cash flow margin, and we compare that to the current price of the stock, well then it's now selling at 25 times underlying free cash flow. And when you think that it's reasonable to say, and it's expected the business will continue to grow north of 25% for the foreseeable future, well, then you have a PEG ratio that's sitting at around 1 or below 1. And that is growth at a reasonable price to me. Even though we've done some deconstructing, of the income statement, that is growth at a reasonable price. And if we keep in mind, the 15 billion that they expect to earn off of their existing customers, the subscription customers, if we average that, for the first 5 years at around 1.2 billion per year, per existing cohort, that's very compelling and makes our forecast a lot more predictable. And so if we're looking at the DCF and we assume WIX can grow top line at 20% CAGR for the next 5 years, and we start to see stabilized margins like they've said they expect to do so in the latest investor call, as well as hit the current steady state free cash flow margin of 25% in real reported terms by 2026, giving them 5 years to turn underlying into real reported, which I think they can, especially if you look at the numbers, 1.7 billion in gross profit. That leaves around $1 billion left for operating expenses, which I think is more than enough for WIX. Well, then my DCF is indicating that a fair value based off 25 times free cash flow multiple and a 15% opportunity cost of capital is around $166 per share, which is only a $19 billion market cap, a number that they almost reached in 2021 for context. So you could see it getting back there if results stay good and market sentiment improves quite easily. Now, that's showing WIX at around 25% undervalued. And because of the upside I've left in this, the potential for a market re-rating and the predictability of WIX's current revenues and earnings, I feel quite comfortable investing at this price. And that, everyone, is why I've been buying the dip on WIX. Hopefully it gave you all some insight into how I look at these traditionally hard to value businesses like a WIX or a Shopify, or even a business that isn't profitable yet, but can, obviously be profitable at some point because of the underlying economics of the business. And if you would like to get access to this valuation model here and various other valuations of businesses, you can do so by joining the Patreon. I will leave a link in the description below, and you'll also get access to many other benefits as well. So go and check that out if you're interested in supporting the channel. But that's going to be it for this video, guys. Make sure you leave a comment below letting me know what you think of WIX and whether you think it's a good opportunity at the moment or not. As always, thank you for watching, and I will catch you in the next one.